Welcome to our EAD tax webinar on capital tax reliefs for shareholders. When we advise clients on their commercial operations and business structure, tax invariably plays a large part of these discussions. Whilst capital tax reliefs are important throughout the life of a business, we know that clients become more concerned about their availability towards the end of the business life cycle. This may be because shareholders may wish to gift shares to the next generation, a shareholder is looking to sell, a shareholder is long past retirement age and is concerned about their inheritance tax exposure. During this webinar, we will cover Section 165 gift relief, business asset disposal relief, and business property relief. For each of these reliefs, the trading activities of a company and their requirements are unique. Starting with Section 165 gift relief, this allows a shareholder to transfer shares for no consideration without suffering a capital gains tax charge. This affects disposals which are not at arm's length. The recipient must be UK resident, remembering that if a recipient emigrates within 6 years from the end of the tax year of transfer, the held over gain will become chargeable. With the exception of trustee recipients, both parties must agree to sign the election, and the shares must be held in a personal trading company, that being where the person controls 5% or more of the voting rights, or shares which are not listed on a recognised stock exchange, which may include AIM shares. So let's have a look at trading conditions. A trading company is one whose activities do not include non-trading activities to a substantial extent. HMRC's substantial test considers income streams, profits generated, the asset base, and employee time employed, then suggests stepping back and considering the balance of indicators in making a determination. Currently, HMRC state that if the non-trading element does not exceed 20%, it is unlikely to warrant any more detailed review. Once trading status has been determined, a secondary restriction applies when non-trading assets are held using the chargeable business asset over chargeable asset fraction. Here, chargeable business assets include only those used within a trade. When considering groups of companies that do not hold 100% of the subsidiary shares, you should allocate the relevant percentage of the subsidiary assets into the calculation. By way of warning, minority shareholdings are not likely to be considered to be business assets. A further restriction can apply where some consideration is received from the recipient. Any value over and above the cost of shares will restrict the amount of capital gain which can be subject to a Section 165 gift relief claim. There is, of course, a separate gift relief claim which invariably involves the use of trusts and has no such trading activity requirement. Moving on to business asset disposal relief and considering a sale event. A shareholder throughout a 2-year period to the date of sale needs to be an employee or officer of the company or group, for the company to be their personal company or group, and where a company ceases to trade, these conditions must be met at this point, and the disposal must then take place within 3 years. The personal company test for business asset disposal relief is different to that of Section 165 gift relief. Here, the shareholder must hold at least 5% of the company's ordinary share capital, and by virtue of that shareholding, 5% of the company's voting rights, being mindful that those shares called ordinary may not be, and shares known other than ordinary may be considered as such. In addition, either or both of the following conditions must be met. By virtue of that shareholding, the individual must be beneficially entitled to at least 5% of the profits available for distribution to equity holders, and on a winding up would be beneficially entitled to at least 5% of the assets. Or, in the event of a disposal of the whole of the company's ordinary share capital, the individual would be beneficially entitled to 5% of the proceeds. Remember, those with relevant EMI shares do not need to meet the personal company test, and the 2-year condition starts with the date of grant rather than the issue of shares. So, when considering the trading status condition, The definition of a trading company initially reverts back to Section 165 gift relief clauses. The legislation then has specific clause regarding joint venture companies and also corporate partnership interests. There is, however, no restriction to the amount of gain like the chargeable business asset over chargeable asset calculation, only the limitation of the £1 million lifetime allowance. There has also been a recent case in the tax tribunal known as the Dr. Allen case, which included the entrepreneur's relief claim, which is the predecessor to business asset disposal relief, and included also a trading status dispute, and is also worth bearing in mind. Finally, for those wishing to hold shares until their death, the inheritance tax relief, business property relief, will of course be of interest. Business property relief provides for any unquoted shares in a company, a controlling interest in a quoted company, and securities of a company which are unquoted, so long as the holder has control over the company. The shareholder needs to meet the 2-year ownership test, noting that this relief is not available where there is a binding contract for sale in place. For the trading status test, the legislation now switches to those companies whose activities do not consist wholly or mainly of one or more of those dealing in securities, stocks, shares, land or buildings, or making or holding investments. The wholly or mainly test being where the 50% mark is breached using the similar indicators as gift relief and business asset disposal relief. Even if the test is met, the whole value of the shares will not be protected if the company holds accepted assets. An asset will fall into this category if it was neither used wholly or mainly for the purposes of the business concerned throughout the whole of the previous 2 years, or required at the time of transfer for future use. Care must be taken with respect to the placement of investment assets within a group, as a subsidiary's entire value could become excluded from relief. Of course, business asset disposal relief is not just as important at death, it can also be valuable when making a lifetime transfer. You can see from this short discussion that understanding your plans are critical to establishing which relief may be of greatest importance, and that this may influence commercial decisions many years before a claim for relief is required. Thank you for listening. If we can assist with your business and personal plans, please get in touch using the contact details below.